Dividend stock versus index funds, which one do you think builds more wealth? Investors argue about this constantly. Some swear by dividend stocks, collecting quarterly payments like clockwork, watching those cash deposits hit their accounts 4 times a year. Others dismiss the entire approach, saying index funds deliver better returns with less work and lower taxes. Both sides have data. Both sides have passionate advocates. And both sides are partially right, which makes this decision harder than it should be. The stakes matter because this choice ripples through everything. Your tax bill changes depending on which route you take. Your income stream looks completely different. Your risk exposure shifts. The amount of wealth you accumulate over 20 or 30 years can vary significantly based on the single fork in the road. This is not about picking stocks versus buying funds. This is about two fundamentally different philosophies of how investing should work. Dividend investing means buying individual stocks or sometimes dividend-focused funds that pay regular cash distributions. You own shares in companies that send you money every quarter. The appeal hits immediately. You get paid while you wait. Quarterly checks arrive whether the market goes up or down. Tangible income. Real cash you can spend or reinvest. And if you do reinvest those dividends, buying more shares automatically, you are compounding without selling anything. Your position grows without you lifting a finger or adding new capital. The classic dividend stocks are companies everyone recognizes, utilities that keep the lights on, consumer staples that sell toothpaste and soap regardless of economic conditions, real estate investment trusts that own shopping centers and apartment buildings, telecom companies that run the cell towers. These are mature businesses with stable cash flows. They are not trying to triple revenue next year. They are not disrupting industries. They have already won their market position, and now they are sharing the profits with shareholders. Think Johnson & Johnson, a company that has raised its dividend for decades. Think Coca-Cola, sending checks to investors since before most of us were born. Think Verizon, paying out billions while maintaining the network. Index fund investing takes a completely different approach. You buy the whole market through a single fund. One purchase gives you a slice of hundreds or thousands of companies. No stock picking required. No focus on dividends specifically. Just broad diversification and a bet on long-term capital appreciation. You are not trying to find the best companies. You are buying all of them and letting the market sort it out. The Vanguard S&P 500 ETF holds 500 companies. You get technology giants and regional banks. You get healthcare innovators and energy producers. You get retailers and manufacturers. Everything. Some of those companies pay dividends, some do not. You do not care either way. You are not investing in dividends. You are betting on the aggregate growth of American business. You believe that over time, corporations will innovate, expand, and generate returns, and you want to own a piece of that entire process without having to predict which specific companies will lead the way. So which approach actually builds more wealth? That is the question we are answering today, and the answer is more interesting than most people realize. Let's start with the case for dividend stocks, because this strategy has genuine advantages that deserve a fair hearing. First, dividends provide tangible income without forcing you to sell shares. If you are retired or approaching retirement, this matters enormously. You need money to live on. With dividend stocks, cash flow arrives automatically. You do not have to time the market. You do not have to decide whether this is a good week to sell shares. You do not have to liquidate positions during a downturn and lock in losses. The checks just show up. That psychological benefit is real. It is also practically useful if you depend on investment income to cover living expenses. You can plan around those payments, roughly how much is coming and when. Second, companies that pay dividends tend to be financially stable. Not always, but generally. A company that has paid and raised its dividend for 25 consecutive years, earning the title of dividend aristocrat, has demonstrated something important. It has consistent earnings. It has disciplined management. It has survived recessions, market crashes, and competitive threats while still generating enough cash to reward shareholders. That track record is not a guarantee of future performance, but it is a signal. Speculative growth companies do not pay dividends. They reinvest every dollar into expansion, research, and market share battles. Dividend payers are usually past that phase. They have already built their moat, they have already captured their market. Now they are returning capital to shareholders because they do not need to reinvest everything just to survive. That can make the difference between panic selling at the bottom and staying invested long enough to recover. It is easier to be patient when you are being compensated for your patience. These are not trivial advantages. For certain investors, especially those in or near retirement, dividend strategies make perfect sense. But they are not the only way to build wealth, and in some cases, they are not even the best way. Now, the other side, because index funds have their own compelling advantages that dividend enthusiasts often downplay or ignore entirely. First, you own everything, which means no concentration risk. When you buy an individual dividend stock, you are making a bet on that specific company. You are trusting that management will continue making smart decisions. You are hoping the industry stays healthy. You are assuming the dividend will not get cut. But companies stumble, industries decline, dividends get slashed when cash flow dries up. General Electric was a dividend darling for generations. Then it cut its payout dramatically. A T&T was considered a safe income stock until it was not. When you concentrate your portfolio in a handful of dividend payers, you are exposed to these company-specific risks in a way that can seriously damage your wealth if things go wrong. With an index fund, you own the entire market. Those companies were reinvesting profits into expansion rather than paying them out, and shareholders were rewarded with massive price appreciation. If you insisted on only owning dividend payers, you missed some of the biggest wealth creation stories of the past 2 decades. You were not in the room when it happened. Fourth, simplicity and cost. One fund, one ticker, expense ratios as low as 3 basis points, which means you pay $3 annually for every $10,000 invested. No need to research individual companies. No need to track payout ratios or worry about dividend sustainability. No need to monitor sector exposure or rebalance between holdings. You are outsourcing the work to the market itself. You buy the fund, you hold the fund, and you let decades of compounding do the heavy lifting. The mental energy saved is worth something. The time saved is worth something. And the lower costs mean more of your return stays in your pocket instead of going to fund managers or trading commissions. These advantages are why index fund investing has become the default recommendation from financial advisors and academics. It works, it is simple, it is tax efficient, it is diversified, and it has delivered wealth to millions of investors who never picked a single stock. But here's where we get past the false choice. Because you do not actually have to pick one or the other. The right answer depends on where you are in your investing life and what you need your portfolio to do. If you are in accumulation mode, your 20s or 30s or 40s, still working and adding money to your accounts every month, index funds make a ton of sense. You do not need income yet. You want growth. You want tax efficiency. You want to own the whole market and let compounding do the work over the next 20 or 30 years. A total market index fund or an S&P 500 fund is hard to beat for simplicity and long-term performance. You are not trying to get fancy. You are trying to build wealth steadily and reliably. If you are approaching or already in retirement, dividends start to look more attractive. You need cash flow now. You want to avoid selling shares during a down market because that locks in losses and depletes your portfolio faster. A portfolio that blends dividend-paying stocks or dividend-focused funds with bonds and some growth exposure can provide income and stability. You are shifting from accumulation to distribution, and dividends make that transition smoother. But even here, you do not have to go all in on dividends. You could hold a total market index fund and simply sell a small percentage of your shares each year to create your own dividends. This is sometimes called a total return approach. As long as your withdrawal rate is sustainable, historically around 4% has been a rough guideline, you are not dependent on dividend yields. You are drawing from both price appreciation and whatever dividends the fund happens to pay. This approach can actually be more tax efficient and more flexible than relying solely on dividend income. Many investors end up with a hybrid approach. A core position in a broad index fund for growth and diversification, plus a smaller sleeve of dividend-paying stocks, or a dividend-focused ETF for income. That gives you the best of both worlds. You get market-wide exposure, so you are not missing out on growth. You also get a steady income stream that helps with cash flow and provides psychological comfort during volatile markets. You are not choosing between two opposing philosophies. You are blending them based on your specific needs. So, which is better? The answer is neither or both, depending on who you are. If you are young and building wealth, start with a low-cost total market or S&P 500 index fund. Let it compound. Do not overthink it. Dividends will be part of the return, but you are not chasing yield. You are chasing growth. If you are near or in retirement, consider adding dividend-paying stocks or funds to generate income, but do not abandon diversification. A balanced portfolio or a total return approach can work just as well, sometimes better than a pure dividend strategy. And if you like the idea of dividends for psychological reasons, because it feels good to get paid, that is fine. Just do not convince yourself it is objectively superior. It is a preference, not a law of physics. Dividends are not free money. When a company pays a dividend, the stock price typically drops by the dividend amount on the ex-dividend date. You are not getting something for nothing. You are just receiving part of your return as cash instead of price appreciation. Bottom line, dividend stocks and index funds are not enemies. They are tools. Use the right tool for your stage of life, your tax situation, and your need for income versus growth. Do not let anyone tell you there is only one way to invest. The best strategy is the one you will actually stick with through market cycles, and that starts with understanding the trade-offs. This is educational content, not personalized financial advice. If you need help building a portfolio that fits your specific situation, talk to a licensed financial advisor. If you found this useful, subscribe for more breakdowns of real investing trade-offs. See you in the next one.